This is a Momentum Media production.
The SMSF Adviser Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hello and welcome to the SMSF Adviser Show. I'm your host, Keith Ford, joined as always by Aaron Dunn from Smarter SMSF. Hello, Aaron.
Hi, Keith. How are you?
I'm doing very well, thank you. How are you?
Not too bad, thanks. First week back in the office after our SMSF Adviser Technical Strategy Days. Last week, we wrapped up the Melbourne event. Great event and, really good to be getting out and listening to all the wonderful sessions that we had, talking on all the, latest topics that we've been discussing on the SMSF Adviser Show as well.
And I'm sure happy to be kind of getting back into your normal everyday routine a little bit, though.
Yes, somewhat. There's still, a couple of months left in the year and there's still plenty to keep me busy, no doubt about that.
Absolutely. And, well, there's certainly some other people that are going to be kept busy. That's my attempt at a smooth segue. Some of those people are going to be in court, which is never the kind of thing that you want to hear, but that takes us to our first piece of news, which is the class action that was launched against some of the auditors involved in the Melissa Caddick case. So for anyone who's unaware, although I think most of our listeners will be at least broadly aware of the case, Melissa Caddick was someone pretending to be a financial advisor. It needs to be repeated as many times as possible so people are aware that no, she was not in fact an actual financial advisor. She was just falsifying that she was, who defrauded quite a bit of money out of some investors, much of which was through SMSFs. She, of course, has gone missing and has been declared to be deceased. We don't want to get into any of the grisly details there. I'm sure many people are aware of what I'm referring to in that particular instance. But long story short, a law firm has started a class action on behalf of some of the victims of Melissa Caddick's scheme. That's McKay Chapman. They filed the suit in federal court in Sydney on behalf of 24 victims, with them alleging essentially that the auditors engaged to review the annual financial reports for the self-managed superannuation funds, failed to identify fraudulent documents that were prepared by Ms. Caddick, and failed to confirm that the assets said to be held by the SMSFs did in fact exist. Obviously not great if that is in fact what they did. Aaron, what are your thoughts?
Yeah, so it's quite an interesting one. It's almost the events that keep on giving, isn't it, with this Melissa Caddick show, I guess we could almost call it.
Yeah, every couple of months, something new comes out. You know, I think it was about 2 months ago that some funds started to be distributed to some of the victims from the liquidation of some of Caddick's assets. One of her homes, I think there's another apartment that's yet to be sold and liquidated to be passed out to some of the victims as some form of compensation. But yeah, it is kind of this drip feed of more stuff coming through.
Yeah, and I guess when you start thinking through this, and it doesn't surprise me ultimately where we now have McKay and Chapman looking at where recourse can occur. So therefore, the fact that we've got an independent audit that needs to be done, and as part of that independent audit, there is both a financial and compliance audit. It does raise questions. To what extent was the audit file sufficiently gathered, and therefore the conclusions that came about by the audits in signing off in those particular years? And I think there were 5 different auditors across the 24 funds that are involved in here.
I believe so. And interestingly, I believe it's only 4 that are actually in the lawsuit. I'm not sure whether that means that one of the auditors, the law firm found there wasn't sufficient evidence to say that they had not breached any, the Corporations Act or anything like that. But it is, I believe there were 5 auditors over the course of the years that the scheme was in place.
Yeah, and the reason why I come back to this doesn't necessarily surprise me is because we have seen this path taken historically. We've seen 2 cases in the last few years. You had the McGoldrick case where we had a question around the investments and ultimately, whether the assets that were inside the fund were adequately, assessed and looked at as such, and that there was no sort of misstatement of the financial position inside that SMSF. And in similar circumstances, we saw the Baumgartner case So in both of those, we saw the trustees ultimately successfully recover based upon the financial loss that was incurred in each of those scenarios. So we have here again a situation whereby we have trustees that have got a financial loss as a result of the activities of Melissa Caddick in this situation, where the audit process, if it had been done as robustly as the profession would attest to needing to be done, in particular when we think about unlisted investments and so forth, then quite clearly there is an argument to say that, the burden of proof or the evidence that should have been obtained should have been probably far better than what it was. And therefore there'll be grounds to successfully sue the auditors. They're the ones that have the PI. So there's an opportunity to look to claim in that scenario. And the ATO have made comment previously about the obligations of auditors, and in particular off the back of those two previous cases, the importance of obtaining sufficient appropriate audit evidence to verify assets, in particular when it comes to unlisted assets. These naturally served as a warning to obtain that sufficient independent audit, in particular with material balances. So some of these might have been quite almost, all of the fund's assets in some circumstances, and therefore, the professional requirements around what would be comfortable in forming that audit opinion bears itself, warts and all in this instance, and therefore exposes the auditors here, as I said.
It certainly does. And of course, one of the things that kind of just, as you read through the statement by the law firm, and which is in the piece, large chunks of the statement, basically there were just fraudulent documentation that she'd put together to support the financial reports. And then just that there were just assets that just didn't exist. It is this kind of thing. Obviously, I've never worked as an SMSF auditor, so I'm not trying to put something saying that, I would have identified this immediately. But when there's just assets that just straight up don't exist, it's certainly not great for the auditors.
Yeah. And ultimately, again, the ATO, when you go through this process, you need to look at and observe as part of that completion of the audit, what information has been requested. Ultimately, any sort of agreements, rights, obligations and stuff that where we might have loans in place, requesting financial statements and details of entities that are linked to the financial statements of the self-managed fund. Thinking about red flags, were there any heightened risks when you looked at the information that was provided that might have then required them to probe a little bit further? And then maybe some other representations as part of that process as well. So either quite clearly she was able to cover things up very, very well and provide enough evidence for the auditors to have done their job to the extent that they may argue appropriately, or ultimately there's gaps and we're going to see those, I guess, found out ultimately, and potentially the auditors then therefore exposed in this claim.
Yeah, I would assume that the auditors that are part of the class action are probably hoping that the court finds that Melissa Caddick is just really good at forging documents.
Yeah. Yeah, it's a tricky one, and certainly not something that, auditors want to be involved in, but that is the heightened risk, and which is why I think, there's a lot of discussion and debate about how much, you should be paying for audits, and it's always referred to it as the grudge purchase. It's kind of like, we got to pay for the audit. Really? What's it serve? Well, quite clearly in this situation, an audit done appropriately would have potentially highlighted the fact that there was an issue here in respect to the representation of the assets, and therefore, the role of the audit does play an important role, and therefore having, the right professional standards in place and the right auditors on the bus, in terms of the ATO and ASIC's obligations is crucial for the ongoing success of the sector. And that's why we continue to see through the auditor program that the ATO has and referrals and so forth to ASIC, that the upholding of standards in this industry needs to remain absolutely front and center.
Yeah. And I guess it's, from the client, the member perspective, they're looking at it, these auditors have given them a clean bill of health in their SMSF. They're the words of the law firm. And if you're on that side where you've been told, no, everything looks good, why would you doubt it? It's why the auditor job is so important, I guess.
Yep. And that's where you'll get this sort of counter argument saying, well, how much is enough and how much is someone prepared to pay for it? And I think these sort of cases will continue to highlight the fact that the audit role is an important role. And yes, it's not just simply a byproduct of how cheap can I get this done for, because auditors are going to have to manage risk within their organizations, because this is the result of what could happen if the appropriate work isn't completed in both parts of that audit process.
Sure. And so we'll move away from criminal activity to something a little bit more standard for the podcast, which is industry associations talking about laws. So that's kind of the bread and butter of what we talk about most weeks.
Yep.
Specifically this week, we want to look at the Institute of Financial Professionals Australia, which has urged the government to rethink its proposed changes to the NALI laws. So they made a submission to the Senate Economics Legislation Committee, basically saying that it fails to address a number of critical issues that were caused by the 2019 amendments. Aaron, would you be able to run us through some of their problems with the NALI laws?
Yeah, well, I guess ultimately in the first instance, a lot of this comes back to, do we actually still have the problems that were perceived originally with these laws? And by that, the concerns that were initially raised around these measures being introduced back in 2018 really have disappeared. So a lot of this started from the zero interest loan arrangements with LRBAs and so forth. And ultimately, I think we've spoken about this to some extent historically on the SMSF Adviser Show. We've had multiple iterations over 5 or 6 years to get to where we are. And it's not necessarily the outcome that the SMSF industry wanted to have here as well. But on the basis that it's now been referred to a Senate Economics Committee, again, there's an opportunity to raise some of these particular issues. And as you said, the IFPA made a number of recommendations in their submission, one of which naturally says, let's get rid of it. You've created a different set of rules here for APRA funds, not necessarily an issue. Well, those same concerns that were raised by APRA funds and SMSFs throughout the journey between 2018 and 2022 in that consultation period, it's very surprising that we end up in a situation whereby we've gone down this path in a uniform approach, but now we have a different set of rules for APRA funds where it's nothing to see here. And we have SMSF that's like, well, actually, there is a bit of an issue, so we're going to put in a different set of rules for you. Let's make things consistent, because that's the approach that you like to do as a government, i.e. Div 296, but we won't go there at this point in time.
You never know. It might pop up later.
Yeah.
It is one of those things that has been consistently talked about. We bring it up a lot, is that inequitable treatment, the different set of rules that are applied to the different sectors of the industry between APRA and SMSFs. And, that is one of the things that they point out. They're saying, exempting large APRA regulated funds for both general expenses and specific expenses, NALI, but subjecting SMSFs and SAFs for both general and specific expenses of the fund is unfair. And that kind of gets to the crux of a lot of where the problems that most associations have been having with a lot of the proposed legislation is that idea that it's targeting different groups very differently and bringing these different rules, and it makes everything more complicated and kind of muddled.
Yeah, and you end up with these nuances, and I think you hit the nail on the head there where you said each different area then has its own problems that then they need to potentially go back and revisit things and the views that have been expressed as part of that process. So the industry took the view that the original problem got resolved, and we kept going through these iterations, and we've ultimately come up with something that tries to address the issue. And look, it's not the end of the world, the situation where the ATO or the government has finally landed from an SMSF context, but it does appear on the basis that we exclude APRA funds a bit unfair, given that as a collective from the superannuation industry, from the accounting industry, financial planning industries, the collective bodies got together to try and get resolutions on this, which is quite rare. And yet we end up in a situation whereby we have this entirely fractured end result. So
absolutely. Yeah. And it's what in many cases, they're just after a bit of consistency between the rules and having everyone operating under the same system. It would be lovely. Another piece of news that we wanted to look at was the ATO, which issued a warning over SMSF loans. Basically, the idea is that the contraventions that are being shown in auditor reports, the contraventions are 16% of all breaches are these type of loans that are in, the prohibited SMSF loans where a related party is, or an in-house asset investment, they're providing money for that. So would you be able to run us through that a bit more eloquently than I did?
No worries. So this is an area for a long period of time where the financial assistance or loans to members has been kind of the top issue of compliance for SMSFs. And, I think you said 16% of all the reported breaches throughout that 19 to 2022 year were in respect to controversial reports around loans to members. And it's just, again, a reminder where the fact that as trustees, there are responsibilities to ensure that, yes, you have your hand on the checkbook, or probably don't say checkbook anymore, but you have your button, you have the finger on the button to do a EFT funds transfer or something. Would that be the way that you'd say it now? But anyway,
finger on the button still kind of sounds antiquated a little, doesn't it? It's like a nuclear, rocket launch type analogy, that one usually.
Yes. Yeah. But ultimately, there is a greater level of responsibility coming with the trustee. The fact that you can have greater access to that money than you would ordinarily through the money being inside an APRA regulated fund, as an example. So, for breaches of these types of issues, there are, of course, a range of actions that the ATO could take, including penalties and then potentially having to consider rectification in certain circumstances as well. And ultimately what the ATO is saying here is we see them, we try to address them. If you've done it, make sure you try and engage with us early through the voluntary disclosure early engagement service. And therefore, whilst we're not going to simply ignore the fact, we will take that into consideration as part of any sort of subsequent process that you enter into to try and rectify the issue where it may be possible as well. So, so it is an area of non-compliance that continues to remain at the top of the ATO's focus, and for good reason. And therefore, again, it's just a timely reminder for trustees, but importantly, advisors working with clients that education piece really focuses on the fact that it might be your money, but only when you retire.
A common theme that comes up. People need to remember that.
Yes.
Yes. And of course, no one, if you can avoid it, you want the ATO to not be paying attention to you. If they're paying attention to you, you might have done something wrong. So
yeah, correct. Absolutely.
No one wants the spotlight.
No.
Well, everyone thought they might have avoided it this week, but we are going to just quickly hit on a bit more Div 296. This time, the idea that with the changes likely to be legislated, of course, we don't know exactly what form they will take yet. We're yet to hear back after this latest round of consultation. But the idea is that Darren Chinappa, who is a superannuation division partner at Nexia Sydney, he feels that basically people need to be looking at restructuring their funds now. Not necessarily pulling the trigger on any of these changes, but looking at the restructuring so that they can avoid some of the tax imposts that are going to come.
Yeah, and ultimately, given that this tax is intending on starting from the 1st of July 2025, we in theory only have 2 financial years to start to contemplate, what things we might implement. So I think from that point of view, there's definitely what Darren's saying is we don't want to be sitting on our hands and waiting, but equally we don't want to be pulling the trigger yet. We know we have an exposure draft. There was a very, 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 very short period of consultation, which is a reflection of, I think, the government looking to really continue forward with this legislation. We may even see it introduced into Parliament, prior to the end of this year with the last round of sittings, which would reflect why they wanted to do it in such a short period of time. And therefore, once we start to get that proper feel of where the government is heading, well, from there, we then start to talk to our clients about what these plans might look like. And I think it is all about planning at this point in time where you say, where do the assets lie? what is the actual impact going to be of this tax? How does it actually stack up against it being held personally in other structures and so forth, and go from there. So any prudent advisor would have flagged these potential issues, been identifying the clients at risk, and then at least starting some form of communication with them so that there is a potential 1 or 2 years of planning and implementation that can go into any adjustments that were needed with these reforms.
Absolutely. And you're never going to let Treasury off the hook for the 2-week consultation, are you?
Ever.
And I think it is important as well to point out, as you mentioned, with advisors should already be looking at this because they're doing their jobs correctly. They're coming up with ideas. They're having a look. Any clients that it's going to affect, or any members that it's going to affect that are not advised, they may not hear this message, but they should probably look at getting some advice.
Yeah. And we could throw a whole range of other things into it, but if you look at the whole limited licensing framework and you see where a lot of the trusted advisor space is, yes, there is an advised cohort of SMSF trustees, and they're more at the, at the outsourcer model. So they're the ones that, I rely on my advisor to do all the things, and they would be having those conversations. But a lot of the, what you call the coach seeker and the self-directed people, may be relying upon the accountant to do that stuff. And in theory, they're not really, they might be able to talk tax, but for the actions that might need to occur, they don't sit within a licensing framework to be able to do it as well. So that's an additional layer that we need to throw over the top of this, which was a problem that we had when the $1.6 million transfer balance cap was introduced as well.
Absolutely. We're going to take a quick break now. When we come back, we'll have an interview with Andrew McVeigh, who's managing partner of Remara and who's an alternative asset manager, basically talking a bit about private credit, private debt, and how that can work within an SMSF. All right, so we're joined now by Andrew McVeigh, who's the managing partner of Remara. Welcome to the show, Andrew.
Thank you, Keith. It's great to be here.
Great to hear it. We love having you on the show. We wanted to start, basically just want to get an idea of what Remara does and a bit of background on the company.
Well, Remara is an asset manager. We have 3 verticals that we invest into. So credit and private credit is our largest, real estate, and we also do tactical opportunities, which is really a fancy way to say private equity in spaces that we know well, which is generally financial services. We manage $700 million assets under management at the moment. Majority of that is in the credit vertical. Our edge really comes from the fact that we generate our own asset base. So we've got a number of portfolio companies. They originate 9 different types of credit, and we essentially package that credit up for end investors.
Right. And so to begin, I suppose, let's get into the idea of what is private credit, how it works, and what should SMSF members and their advisors, what should they know about it?
Certainly. Well, credit, if you start with the base asset, credit is universal amongst private and public credit. So similar to equities, where you've got shares that trade on a market and you've got private equity, you also have credit assets, which are generally to individual or company borrowers. You have fixed income, which is essentially the public market version of that. And credit borrowers have individual loan pools. They get packaged up multiple times, and essentially they're publicly available for investors to invest into. And that's traditionally known as fixed income. So I think most people are probably aware of fixed income, what that means. Private credit is where that same asset pool essentially is just available to private investors only. So they're generally not market listed. There's a lot less liquidity available in those. And there's generally limited second markets or secondary markets that investors can liquidate their investments and realize their investments. So private credit is a market that is the same credit assets, but they're just privately sold to end investors through a series of different types of vehicles. So single name trusts, multiple credit trusts, or diversified credit trusts.
Right. And so looking at it from the SMSF perspective in particular, what should they be, I guess, on the lookout for when investigating private credit?
Yeah, there's a couple of really key aspects from any investor's angle. And private credit, the biggest thing you need to be aware of is less liquid. So with fixed income, they're generally publicly available and you can trade those actively on exchanges or markets. Private credit doesn't have that secondary market liquidity. So you're relying upon the manager or the platform to provide you liquidity if you need that liquidity. As a result, though, you actually get a better return profile from that. So it's kind of, double-edged sword in terms of less liquidity, better return profile. So you really need to have a consideration about what your portfolio needs, what you need as an individual, and ultimately, is private credit the right for you for an extra return if you don't need that liquidity offering? The other aspect, which is a really interesting aspect, is there's less capital variability in the underlying unit prices and things like that. So with fixed income, generally they're fixed returns. So, we've seen lately the RBA's increased base rates pretty phenomenally over the last 18 months. And that has had some pretty prolific impacts to most people's portfolios if they had bonds and other fixed income instruments. Private credit is generally floating, so therefore it doesn't have that same capital variability. So from an emotional perspective, you're not seeing your investment move every single day based on RBA rate changes and economic changes and things like that. So generally, when you're looking at your portfolio as a whole, there's a little less emotional impact of movements within that portion of your portfolio. So there's a lot of an opportunity there for you to be able to put almost a set and forget and not worry about that capital volatility within your portfolio.
Right. And so you mentioned, obviously, it's less liquid than some other forms of investment. When you're looking at it from an SMSF perspective, as it is a long-term investment, it's you're wanting to hold, the illiquidity is probably less of a concern for someone investing within an SMSF than it would be someone outside of it.
Yeah, you're correct. So I think one of the key things is what state you're in with your SMSF. So if you're in the accumulation phase, then the opportunity to put money to work in private credit where there isn't that need to gain immediate liquidity or isn't that need to gain immediate liquidity means you can actually get a return uplift. And that return uplift can be pretty sizable in terms of what you traditionally get in fixed income and public market bonds. And that's certainly going to provide an opportunity to get a better return profile. And from a private credit perspective, there is a consistency of return that you should get month in, month out that really forms the bedrock of a consistent income profile, which will help with taxes and payments and potentially soften the burden from, reduction in dividends and rentals and increase in interest rates if you've got debt within your self-managed super fund.
Right. And I suppose if it's income generating, then someone in the pension phase might be okay interested as well, depending on the rest of their portfolio.
That's correct. Like if you look at annuities as a product essentially invest into credit assets.
Right.
And that's essentially the underlying asset pool that works for annuities and annuity providers. So the opportunity for you to create, quasi your own annuity style income stream off the back of a private credit investment is certainly available to SMSF investors.
Right. And so what forms of private debt or private credit are available for all investors or SMSF investors in particular?
Yeah, so there's generally a number of different forms. So some of the more recent trends, and when I say recent, I mean the last 10 years, has been single-name real estate transactions. So these are generally larger ticket deals, $50 to $100 million. You've got credit managers who will originate the underlying credit and then tranche that up and sell that off to end investors. It's a very good model. It works really well. The biggest challenge is you're extremely concentrated on one single deal, one single obligor, one single project. So traditionally, there's been a lot of single name bonds, single name credit assets that you can buy portions of or slithers of or invest into. The second is credit funds. So credit funds are generally structured in a way where you've got an individual asset exposure. So again, if we take property as an example, you'll have a credit manager who will originate multiple forms of underlying real estate credit. You'll invest into their fund and you'll invest into each and every one of those underlying loans. Then you come to managers such as ourselves who are diversified credit managers and our private credit income fund specifically, where we've got 9 different types of credit assets. So this is everything from smaller ticket real estate development, asset and equipment finance, business loans, insurance premium finance, 9 types of varying credit. And we invest across the spectrum in 4,500 contracts within our fund, across our platform overall, 12,500 contracts. So it's highly, highly diversified. You limit the risk of individual obligor exposure, and you also create further diversification across industry, state, asset class, and a multitude of other items, which really then limits the risk of the overall portfolio.
Obviously, most advisors, when they talk to their clients, they'll like the term diversified that you've dropped in there. That's always something that advisors and all investors should be on the lookout, of course. When investors come to you, people that you work with in this space, you mentioned all these different types that you've got. Do they generally aim for one type, or do they take you up on your diversified offering?
We generally only offer diversified. And the reason why is our platform is based on providing a product that offers you ideally a lower risk profile with a higher return uplift. So we have 3 portfolio companies that originate our 9 different types of credit assets. So for us, we generally only offer to SMSF and wholesale and retail investors that diversified option. We don't offer options for single name exposures and things like that. We do on the institutional side, but we don't for the wholesale, SMSF and retail. The reason for that is across the institutional side, they've got more resources and things like that to underwrite the credit. They've got bigger positions and they essentially can diversify themselves within their pool. That generally isn't available to most SMSF wholesale investors and retail investors. So that's the avenue that we provide for them. And that's kind of the benefit of investing into our vehicles.
Yeah, I suppose those institutional investors have a lot more capital that they can withstand a higher level of risk.
Yeah, and they've also got the opportunity to do a greater level of underwrite, more access to information, and generally can control their own terms. So that gives them a greater level of control and a better overall portfolio aspect, whereas that's generally not available to the smaller SMSF wholesale investors and kind of retail investors, which is what we provide as a manager. We do all of that work, given we've got the background experience and legacy within the assets.
Yeah. And so you've mentioned diversification. What are some of the other ways that, the private debt as an asset class can add value to a portfolio, either broadly or to SMSF in particular?
Yeah, the second area is really a lack of correlation to most other asset classes. So a really good example, the equity markets are going through a bit of a difficult phase at the moment. So private credit is generally unaffected by equity. So if you've got shares and larger share portfolios, your private credit is going to largely be unaffected by a share market going up or a share market going down. Real estate values, again, dependent upon the type of private credit you invest into. If you're heavily invested in real estate, private credit can provide a bit of a diversification for pure equity investment real estate. So the low correlation to most other asset classes in Australia is definitely a positive for any investment portfolio.
Yeah, that lack of correlation, it always is helpful. Obviously, many different types of investments. If you've got one or the other, one will go up and the other one will go down at the same time. So having
Correct.
something that can,
be that bellwether. Yes.
Exactly.
Yes.
In the middle there somewhere.
Yes, exactly.
Doing its own thing.
And one of the third benefits is that consistency of income that I've mentioned in the past. Month in, month out, you should receive a very consistent income stream. And that provides a level of security. So when markets are up, markets are down, you've got a consistent income stream that allows you to make decisions off the basis of knowing exactly what you're going to get next month, the month after, the month following that. So for us within our private credit fund, on the 15th of every month, your distribution is received. You know what it is. It's very similar to the prior month. There are some small variabilities, but they're very small variabilities, talking about a couple of basis points month in, month out. So that consistency of income yield with limited capital volatility certainly provides an emotional benefit in terms of how you manage your portfolio when there is periods such as this where the markets are a little bit volatile and you're not sure whether property's going up, property's going down, whether markets are going to go up or down, and what that will do to your overall portfolio. Yeah,
you mentioned the emotional aspect of this. Obviously, when investors are working with advisors, that is helped by the advisor themselves being understanding these things and being able to counsel their clients. But I'm sure having that asset class that isn't so volatile has to help the advisor's job on that front as well.
I certainly think it will. And that consistency of income is definitely going to help because it allows them to plan for, okay, what is the potential dividend? What is the potential rent? What's the potential cost that's going to be coming through on that investment portfolio? And then the consistency of that income stream from the private credit is it's like that bellwether, as we said. So you can count on that month in, month out, it's going to be received, and it is very much a floating rate style return. So if the RBA suddenly drastically decreases rates or increases rates further, you're going to receive a margin above that rate increase. So you're actually not setting your return today and then having that eaten into or improved by an RBA who's either cutting or hiking rates.
I personally, with a mortgage, always rooting for lower rates, but, that's a personal, not a professional opinion. Outside of that, what are some of the major considerations that I guess both advisors and members should be looking at when they're trying to assess the asset quality?
Yeah, there's a number of really key items, and private credit is a fairly new asset class, and it's still fairly opaque in terms of some of the really key attributes and drivers to the asset class. The biggest one that I would suggest is look at the credit strategy of the manager and the fund that you're essentially investing into. So large ticket exposures or large ticket credit exposures provide challenges to a portfolio because you are significantly concentrated to an asset or an underlying loan pool. So, diversification is key. We've mentioned that. But if you've got as an example, 10 loans worth $100 million, one loan goes bad, you suffer a loss overall. If you've got a $100 million pool, but it's across 1,000 loans and 10 loans go bad, the impact is negligible. So diversification in the underlying obligor pool is critical. Diversification in what you choose is critical. So members need to go through it, and managers and investment advisors need to understand what is the level of concentration they're ultimately taking in that vehicle or that fund. And if that is too high, they need to then spread that across multiple managers. So what we essentially do from a product perspective is we've got such a diverse array of credit within our private credit strategy that we essentially do that diversification. So what we're hoping to achieve is to be able to provide an already diversified pool of credit for investors. The second aspect is what's the manager's exposure? So a lot of private credit managers will raise capital, will originate loans, will receive fees off that, will receive management fees, but they don't suffer in the losses if there are losses that go through that pool. So probably the second key question is what's the experience of the manager and are they aligned to investors? Because in credit assets, you don't get the equity style returns, you get a lower return, but you're just on a similar risk if something goes wrong. So really the key here is what's the manager's exposure, what's their experience in writing credit, and are they exposed to potential downturns in credit and the quality of those assets.
Right. And what's the best way to find that information when you're trying to find the experience and their exposure and things like that? Because I know it's not always a super transparent space.
Correct. I think conversations with the management team, conversations with the distributor of the product, conversations with the investment specialists are going to be critical to understand what their history of the individuals are. There's obviously research reports that are provided for most funds. So if you gain access to those research reports, they'll generally go through what is the experience of the investment committee, the managers, the advisors through that program, and you'll generally be able to get the information from that. The second component is how much does the manager invest into the fund, or how is the manager remunerated for that fund? So for us as an example at Remara, our private credit fund, we provide a 5% risk retention across every single loan that we write. So across 12,500 loans, we've got the bottom 5% tranche of every single loan. So in effect, we lose our capital before any investor loses their capital. And that for us provides, alignment of interest with the investor. It really hones our focus on the credit quality, the asset quality, running those assets and ensuring that if there are problems that do come up within the portfolio, and there always are, that we can manage that process, and we're incentivized to, because we will ultimately lose our capital before investors do.
And my understanding, and of course, correct me if I'm wrong, but my understanding is generally private credit investment managers like yourself usually are higher up on the chain for being paid back as a creditor.
Yeah, sometimes. It really depends on the structure of the fund.
Yeah.
So you might actually find there's a lot of credit managers who don't actually invest into their fund. So they'll receive management fees, their platform and their companies will receive fees for writing loans, but they might not invest into that underlying asset class side by side or pari passu with their investor base. So those types of questions are really critical because you understand the incentive of the manager to write the credit and what potentially types of credit they will write and how incentivized they are to just get the money out the door once they've raised it.
It does certainly sound, on my end, it sounds like a good thing to have the person that's managing it also have some skin in the game.
It certainly is. It's a really key factor from my perspective across any asset class, I think. On credit in particular, I think the ability for the manager to have alignment of interest, and particularly that first loss alignment where they lose their money before investors, is really critical because it will change the dynamic of the decisions that get made in terms of credit origination, credit standards, and then the servicing and collection process of that credit and how you manage that through the life cycle of the asset.
Perfect. Well, that's all I've got for you today, Andrew. Thank you very much for joining the show. I really appreciate it.
No worries, Keith. It's been good to be here.
Perfect. Thank you. And we'll just take another quick break and be back with Aaron. All right. I'm joined back again by Aaron Dunn. Aaron, what was your most interesting thing this week?
Well, we've been talking about Div 296 for the last few of these, so I'm going to deflect away from that. And I think
it's an upset, that one.
The article that you put together, Keith, around Melissa Caddick, I think is certainly going to be something that is going to get a lot of airplay over the coming months and its impact that we will see on the audit profession, just like we saw with the Camembert case. I call it the cheese case, not Camembert, but Cam and Bear, was McGoldrick, and the Baumgartner's case. Both of those, when they landed, did have a very significant impact on the audit profession. And I can see this Caddick case having a very similar outcome.
Yeah, there will certainly be progress, but as it is a class action, they do tend to take a little bit of time. So there may not be an outcome for a little while, but it will certainly be interesting to keep an eye on the progress and how it all shakes out, I suppose.
Absolutely. Well, as is always the case, if anyone has any suggestions for topic speakers and so forth, how can they get in contact with us? editor@smsfonline.com.au. That's where you can get to us. I would also just like to, I think I've got my timeline correct here. I want to just congratulate all of the winners from the SMSF Awards. When this podcast hits your platform of choice, or when you get an EDM from us with the download link, it will be after the live stream has happened, I believe. So congratulations to everyone who won. And of course, congratulations to the finalists as well. It is great to be one of the select few that is nominated and has made it to be a finalist. That means you've gotten a lot of love from within the industry and people who work with you. But also, yes, big congrats to the winners, and keep up the good work. Absolutely. Very well said. Well, thank you everyone again for joining us for this week's edition of the SMSF Adviser Show. Have a great rest of the week, and we'll catch you soon. Bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.